I want to call this an incredible global sell-off and make it really dramatic and be sensationalistic, but it's not so bad here in the U.S.
No, it's not. I mean, there are obviously a lot of really good microeconomic data coming our way in the last couple of weeks. Obviously, this has helped rebalance our thinking from that October sell-off. So, we're not in crisis mode yet, but there are certain negative elements hidden kind of what I call under the radar.
Right. So what are they? I mean, we're still looking at basically all-time highs, almost, on all of the indexes. We added, 320,000 jobs last month, a blowout number.
Right.
Everything's looking good. I expect to see upward revisions in GDP from economists. So where's the bearish sentiment hiding?
Well, I think the bearish sentiment really is external. It's coming from China. It's coming from Europe. I mean, one of the things that wasn't much discussed this week was the fact that the Bundesbank, or actually last week, sorry, the Bundesbank came out and they said, well, we're paring our growth expectations back for 2015 to 1%. That is not a healthy sentiment in Europe. And obviously, when we had that initial October sell-off, I mean, I think we can ascribe a lot of that to weakness in Europe as well.
Absolutely. And, I mean, you do see still, as I said, drops of more than 2% across the board over in Europe. Lately, economists have begun saying that the U.S. is not quite as interconnected globally as we maybe had thought before, that we won't see, for example, a huge drop in exports because of problems that are going on in Europe. What do you think about that?
Well, I'm not sure it's, a conspiracy theory to say that, the ultimate effect of decoupling is yet to be determined. I mean, we have divergent central banking throughout the world right now. Definitely a two-speed economy is something that the IMF's Lagarde has spoken about many times, saying it's a very dangerous place to be. We saw the BIS come out and say the dollar could have a really outsized effect in some EM economies, and with the commodity sell-off, these are definitely risks that can affect U.S. stocks as well as U.S. credit.
And China, we've seen, historically, bad news out of China really hits us hard when it hits us. What are you hearing right now?
Well, the thing about China, I mean, today, so they increased some of they tightened some of their collateral requirements. But forget about the mechanics of that. Really what it means is, well, is there a question about global growth? And also, I think the market has expected China to be on a one-way fiscal easing or monetary stimulus path. And, well, that's kind of not what's happening right now.